everyone, and welcome to a new ATFX video report. This is the weekly market update, and I'm here just to give you a quick, fresh update about what was the last data released on the market, particularly this day, today, non-farm payrolls and unemployment rate of the United States. One of the most important numbers that you can expect on the market, one of the numbers that move super strongly the price, particularly the dollar and the US equity, which is the biggest market in the world. The exchange from United States, the exchange from New York, Wall Street is the most important market in the world, and non-farm payrolls is the most important data release, causing a lot of volatility. So what was the results this day, this Friday? Let's start with the data results of non-farm payroll, and then let's go to the summary of the week. I would like to share with you also more than like I'm usually just go to a kind of chronological review of every single day on the week and what was the data results for every single week of the day. However, this week I want to base this report in kind of reflections about the position from Central Bank of Europe, the position of Federal Reserve, and the position from Bank of England. Why? Because we are in a kind of inflection point. We are kind of a break point where we need to decide. Well, we need to either take one position or another, because central bank seems to be in a hedging moment, like deciding between a strong position and very strict interest rate policies, or super dovish and soft position in terms of interest rates. Market is discounted the second case, this case, but it's not the first time we have seen surprises in the market, and actually the non-farm payroll today, it was causing certain surprise. This is the last update I published on the social networks, ATFX on social networks, and I was just sharing here the strong jobs report boosts the dollar, US unemployment rates falls again, more jobs created than the last month. Therefore, please keep in mind, last month, 4 weeks ago, when we got the non-farm payrolls, unemployment rate was actually worse than expected. And these negative results caused actually a bullish market. All the market was rising because based on those results, Federal Reserve was getting the perfect reasons and excuses to turn to a dovish policy, more softer. Even the speculations about interest rates cuts jump out on the market. Basically, the pools start to increase the percent of perception that interest cuts will come in the coming months. But today, with these non-farm payrolls, with this data, maybe that percentage will change. The second thing I was about to comment with you before we go to the chart, well, you got here the results. As you can see here, the result was basically non-farm payrolls, 199,000 new employees created versus the expectation of 180,000 new jobs created in the United States. However, also, it's fair to say that actually the average for the whole year was in around 240,000, and therefore this is better than expected, but still below the average of the year, but still better than expected. So it was causing actually a positive impact on labor market in the United States, and therefore probably we're gonna review now the charts, but most probably negative impact on the equity. Unemployment rate dropped again from 3.8 to 3.7. The expectation was 3.9, so it was expected to keep increasing the unemployment rate, and it's actually dropping to 3.7. And again, this caused probably a shift on the position of the market. Market assuming that Federal Reserve gonna turn dovish, and now with these numbers, maybe market gonna start to be afraid that the Federal Reserve actually is not considering interest cut in the coming months, and even inclusively could be more hawkish than expected, right? Now, saying that, this is the mainly points I would like to discuss on the summary of the week. I was just published this also for the blog of ATFX Connect, and I will just to share with you a few moments here. The breaking news, the top one, is just the data we just commented right now, the employment data from United States. Second one is how Europe is actually discussing the fiscal policies. Keep in mind that Europe got, since 1992, since the foundation of Maastricht agreements, they got a very strict policy in terms of deficit and inflation. And because of this, let's say since COVID, many countries, the most important countries, including Germany and France, has been breaking these rules and these policies, and they got the compromise to come back to the main fiscal the fiscal rules that they set up in the 90s, Maastricht agreements. And it means like government debt should not exceed 60% of the GDP, which is by far exceeding that in the case of France for sure. Italy, not even mention that, is worse, the worst case in Europe. Spain also is around about 100% of GDP on debt. So all of those countries are breaking actually the fiscal rules. And also deficit at 3%, that was the target and the goal. And still, many countries in Europe are getting either so close or about the 3% of deficit, which means like several adjustments need to be applied. And this is the thing. The new battle in Europe gonna be turning in terms of this. Why this is important for the market? I can tell you why. Because if the fiscal rules come back in place, it means that the economy actually gonna start to reduce the cost, reduce the expenditure, the public expenditure they're generating, and therefore reduce the size of the economy. And if they reduce the size of the economy, all variables, including inflation, but also employment and many other variables like growth rate, public services. After all, at the end of the day, goods and services are actually including private and public sector. If they reduce the deficit, they need to reduce the size of the public sector, and therefore it means increase the employment rate, reduction of the GDP, reduction of the economic growth, and so on. Therefore, a recession in the economy if they need to apply fiscal rules. They know that. They are just waiting, keeping on hold these decisions, but we're getting close to that situation. They need to take a decision. Also, this morning we got freshly the German inflation rate, which it was 0.40 month to month by November 2023, but also the monthly one, it was a 3.20%, dropping from 0.80% in October. So again, inflation is dropping in Europe, and this is another reason why the markets, investors, traders, funds, banks, it doesn't matter, everyone is expecting that actually the policy is going to start to be softer and softer because there is no need for more hawkish policies from the Central Bank of Europe if inflation is not anymore a risk. But that's the main question, what we could expect for the next week from European Central Bank. And I just share with you here a few reflections to give you more or less what's the idea that we could expect. One interesting topic that I mentioned in this article closely is in the case of Federal Reserve, the target, the goal of inflation is reduce inflation to 2% level. In the case of European Union, and based on the Maastricht agreements from 1992, the 2% of inflation should be the top. Therefore, they are the compromise, the ECB, the Central Bank of Europe, is actually going behind of a target or a goal of lower than 2% inflation, which means even if the Federal Reserve decides to stop and hold the interest rates or even cut in the future interest rates, even in that case, European Central Bank should, if they are loyal and they keep their word, they should keep moving forward until they got inflation below 2%, not 2%, which means, like, technically speaking, they are farther from the target, from the goal, than the Federal Reserve. Keep that in mind because it's important. Now, also, from Federal Reserve perspective and Bank of England, we also got the governor of Bank of England, which is Andrew Bailey, said in recent days that he is pushing back against, brackets, okay, against assumptions that we are talking about cutting interest rates. Bank of England want to remove from the table any speculation about possible interest rates cut. So again, it's trying to reduce from our minds as a traders and investors the idea that markets should rise because interest rate cuts will come. Again, the governor of Bank of England say, please, we are not considering, we are against assumptions that we are talking about cutting interest rates. So this is super clear. They want to reduce the speculation that all these banks, Central Bank of Europe, Federal Reserve, Bank of England, are considering interest rates cut. In the other hand, and in the other side of the world, which is Japan, Asia, we got the opposite situation. We actually got many speculations suggesting that Kazuo Ueda, the head of Bank of Japan, is about to change the monetary policy and to actually switch or finish the super low interest rates policies, which means eventually increase the interest rates. We have been monitoring the inflation rate from Japan. In recent reports I have been recording and sharing with you here. So we need to keep our eyes on those numbers because a change on the policy, on the monetary policy of Japan, will affect to the market dramatically. I will show you why. Let's go to daily candles, and also let's go to what is the dollar yen pair. So you will understand. Here it is. You will understand. You see, all this drop is because the assumption and the speculation that Bank of Japan, it's over with the low rate monetary policies for the last 20 years. It's over. Market is just waiting an announcement officially, but the Bank of Japan is postposed this announcement, postposed the decision. Either we are talking about that probably by the first quarter, probably January or February, Bank of Japan will finally take a position officially on the monetary policies and eventually switch those monetary policies. This is all. In terms of equity, as you can see, market is super strong. In the case of US, it was open today with a bullish gap. But I believe that because the expectation, it was based on the EDP pools on Wednesday, which it was not so bad. They were expecting actually that today we got a surprise with the labor data and actually confirmed that the labor market was getting weaker. It wasn't the case. It wasn't the case. You can see that the last 4 hours, actually, the market has been pushing up strongly. Take a look also here. It was dropping, and now is trying to recover the main levels when the market was open this morning with the futures in Europe. SP 500 future was discounting this, and I will say that it's mainly lateral, still quoting about 4,600 points, which is a really strong signal. But I will just wait for precaution, because look, 4,600, it was the resistance. This jump with this massive gap here is very suspicious, and it could change in a few hours. So do not trust completely in this movement. In the case of NASDAQ, also is super bullish. It's strong. It's coming back to strong levels after a few days just dropping. But still, precaution and keep your eyes open, because if we'll take a look on this, hold on a second. If we take a look on this from long-term perspective, you will see actually that we are facing a kind of stop on the price, a lateral run. Let me check for daily sessions. Boom, here we go. You see, this is a resistance already, officially speaking, based on the chart, right? And the worst case, Russell 2000 finally break out this level. It was getting close to the next level we announced in these videos, which was the neckline extended. Once he arrived to those levels during the week, Tuesday and Wednesday was dropping back down, and now it's pushing back again to those levels. So, which is like around $1,890, $1,900 points. So it's very interesting to follow up. In case of Europe, we got the German market pushing forward again, pushing forward. EVEX Spanish index also, it was dropping since yesterday, but today was trying to recover certain levels back again. In the case of dollar, very interesting to see what was the reaction of the dollar after this labor market result. It was, first of all, super strong. I was just posting on the social networks the reaction of the dollar rising super strongly. But as you can see, it's getting colder again. It's retracement again. It's pulling back again the strength of the dollar. And in terms of euro dollar, drop and then pulling back again. You will see here. We saw this drop and it's pulling back again. Still almost on supports in the case of euro dollar. As you can see here, it's just moving step by step, little by little, to the supports of this kind of uptrend. But again, if we see the dollar getting stronger, euro dollar is going to drop. And euro dollar, I mean, we probably need to expect the worst from European Central Bank next week to go further in euro dollar and get more clear fundamentals to take a decision on that pair. In the case of gold, we see that the market is actually moving really, really weird. I mean, we got the supermassive gap lift on Monday night when the Australian market was open. Since then, has been getting lower and lower. Right now, we are in $2,008 per ounce, and it still looks like he's coming back to $2,000, which could work as a kind of support because it was an important resistance. But again, if after this week the dollar, the gold is not quoting about the $2,000 per ounce, probably it's just a dilatation and it's gonna keep moving inside of these runs that I shared with you many times in previous videos, as you can see, blah blah blah, so on. Do not trust in that breakout unless you can see that the price is well consolidated about $2,050 per ounce, right? Again, I'm not here to share with you any kind of advice. I don't want to influence on your criteria. And if you want to invest in financial market, I must to say, my duty is to inform you that you should contact first with a financial advisor just to analyze your case in particular and see what's your interest, okay? Oil is the last asset I want to mention with you. It's pulling actually back after massive drops. It's really complex, the situation of oil right now. We got different factors influencing this. First of all, it was a discussion between Saudi Arabia and African countries, producers, which is Angola and Nigeria. Both of them were not so agree with the cut of the production for the next year. After all, the agreement they did, it was actually super low compared with the main first intention, which was the reduction of 2 million of barrels. They ended in 900,000 of barrels, which is less than 0.5% of what they were planning. All of these reasons, the inventories from US this week also was super high, and so on, is dropping the price down, but still is actually doing well, is moving back to track, as you can see, trying to pull it back. Again, do not touch oil in my eyes. I think this market needs few movement months, because if you see it's pulling back, but it's still below the moving average, below the resistance levels, which was this past support, and therefore it could turn back to $65-68 per barrel, which is actually an important support area. And then probably the most prudent, a conservative measure is just wait and see what happens with this pullback, if it's gonna continue dropping the price or not. Okay. Last thing for this week, it was the amazing results, the amazing performance done by Bitcoin on the market. It was so impressive, so impressive. As you can see, well, I believe that basically is the strategy is done. Even the discount that everyone is talking about, the ETF on Bitcoin, spot Bitcoin, to be approved the next month, January, between the first to second week by the SEC in United States, which will be a kind of massive change, historical movement for the currencies. But still, we don't know if it's going to be approved or not. And even in those cases, in the case that it's approved by this, by that, by different regulators in Europe or in US, in this case, we're talking about US and BlackRock request. Even if it's approved by the SEC, by the security agency, financial regulator in the United States, the price is probably discounted this already. So watch out, because maybe instead of bullish movement in Bitcoin, what we can expect is, in case that they do not approve this, actually could drop strongly. So just that. But again, it's a really good asset. It's doing super well this year. It's rising when the market is dropping. It's rising when the market is rising. So therefore, it's a buy and hold asset to keep on your portfolio. And again, this is not an advice. Just talk with a financial advisor if you want to invest in financial markets, because it implicates certain risk. I think that's all from my side, my friends. I hope you like this weekly quick report. And remember, if you like it, please subscribe to the channel and give me a like, because that makes me, first of all, feel the satisfaction that you are there and you like this content, and also be all in touch with you. Leave me comments with requests if you want to see any other market. You can also contact me through the social networks, and any requests I will take in consideration for the next videos. Take care and good luck with the market. See you soon. Bye bye.